Alrighty, live pictures from the floor of the New York Stock Exchange and the NASDAQ market site as we wrap up this Thursday of trading. It's Market Domination Overtime, giving you full coverage of all the moves to get you up to speed on the action from today's trading. Yahoo Finance's Jared Blickery standing by to break it all down. Jared, I think we held on.
Yes.
I think it's 0.06. Is that what I'm saying here? My glasses need to be checked.
Yes, S&P 500, we'll start with there, up 4 points or 6 basis points, but that was enough for the 5th straight win in a row, and you can extend that to the NASDAQ composite, also for a win there, and then the Dow, also for a record win. And we'll take a look at the small caps as well, up 1/3%. Not a record for them, but we like them still. And let's take a look at the sector action. The leader all day has been the material sector. That's XLB in the upper left. That's up over 1%. Then you have tech and industrials. Those are the three outperformers. And then to the downside, we only had energy crossing the 1% threshold. To the downside, number 2 slot was XLY, and guess who's in that? That is a Tesla group, so that's consumer discretionary. We also have Amazon in there, but it looks like Tesla, the main culprit there. Not a lot of red in terms of the mega caps. You see Microsoft in the lower left, that's down about 0.75%. Meta, though, some nice outsized gains, up over 1%. And it's nice to see the semiconductors just flying again. Intel up almost 4%, AMD 3.5%, Global Foundry also 3.5%, Microchip 3%, and the list goes on there. And once again, in software, we see some decent gains, but not quite as widespread as we do see in the chip sector. Snowflake and Okta each up more than 3%, looks like almost 4% for Okta there. And let's take a look at some of the leaders. We don't have a lot of red here. So the things that didn't work today, PSEE is small oil, also regional banks. We hit those before. But in the number 1 spot, Myles and I are going to hit crypto in about 30 minutes. GBTC is my crypto proxy. They're up about 3%. TAN is solar. ARK Invest is disruption. IPOs, we know those are speculative. And so the top 4 in my list are all pretty speculative, and we're seeing a lot of money flow into those fringier parts. And I will leave us on the Dow. Aside from the mega caps that we covered, guess what? We're seeing a lot more red than green there. And it actually looks like almost an even split, maybe one more. But to the downside, JP Morgan led the big banks down. Also, Coca-Cola, Verizon, each down about 1%. Myles.
All right, risk on in this market, certainly looks like. Jared, we'll talk about that a little later on. Thanks so much. All right, well, the AI revolution is reshaping Wall Street, Silicon Valley, and Washington. Christina Hooper is the chief market strategist at Man Group and joins us now to discuss. So, Christina, I want to start with something that you looked at in the top of your note, which is the way that AI is reshaping industries. And I think something that we kind of feel acutely here in the tech world is the loss of jobs. It feels like it's all one direction, but that, I think in your view, is only one part of what is likely a longer story with this technology.
Absolutely. I think what we are going to see is some significant unemployment over the course of the next several years, perhaps a little longer. But then, of course, we're going to have a lot of new jobs created. They may not be a match in terms of skill set for those jobs that were lost, but they may well be. And I think the most important thing is if we look back at past innovation revolutions or industrial revolutions, however you want to describe them, those were periods where there was an enormous amount of trepidation, reluctance. We know the Luddites were sabotaging the delivery of farm equipment, but ultimately it ended up as a positive for the overall economy and as a positive in terms of job creation. But that took some time, and there is that period where you do see elevated structural unemployment.
And I'm curious, from an investor standpoint, where right now the conversation is about a lot of the names Jared was mentioning, the mega caps, the investment, trillions of dollars being invested around all these data center projects. Do you have concerns around that? How do you think about the way that that has drawn really so much of the attention and the conversation for investors towards those spaces over the last couple of years in lieu of, it feels like, almost anything else?
Well, I guess I would just say that we speak all the time about the importance of diversification, right? And here's a scenario where we are putting a lot of eggs in one basket. Now, companies are very comfortable doing that. Survey after survey indicates, and if you look at corporate earnings reports, when they're on their calls, they're talking about how they're comfortable investing in AI. And in fact, they think the greater risk is not investing enough, and that they're seeing some ancillary benefits from advancing technology and putting that money into AI. So I think that certainly we do have to worry that there are risks, but I'm comfortable that the companies recognize that and are just moving full speed ahead. We should expect, though, that even though companies are comfortable with it, there could be some kind of hiccup with the stock market, as we have seen. There have been a few times where the stock market has caught its breath. Investors have gotten a little nervous, whether it's the DeepSeek announcement or the MIT study saying that most companies aren't seeing any kind of real return on their investment.
I was going to say, it was only this year that NVIDIA stock was down 18% in a single day. And it feels like we just kind of all forgot about that. And along these lines, I'm curious if it's felt in your conversations with investors like it's hard to direct their attention to anything else. Because as you mentioned, there's a whole world of other assets out there. And even now you look at, okay, everyone wanted a piece of infrastructure or private credit like 4 years ago, and they meant like roads and infrastructure. And now it's like, oh, we could just do data centers too. We could just make that an AI trade as well. Does it feel like it's hard to have conversations that are away from this theme with some of these other allocators?
Interestingly, I think there's a real sense among a wide variety of clients, whether it's institutional or wealth / retail, there is an understanding of the importance of diversification. I think AI is what's exciting to talk about, but that doesn't mean that's what the portfolio looks like. I think for many, what they have is pretty significant exposure to fixed income, to alts. They're well diversified within the equity space, or at least they're thinking about it. Because, of course, as time continues to go on and the rally strengthens, most are likely overweight U.S. tech and may recognize some vulnerabilities there. Certainly, some of the clients that I've spoken to are thinking in terms of that. Some of the investors I've spoken to, and I think that what we're likely to see, and we've already seen it to a certain extent, because gold has been a really strong play this year as well. And so I think there's a sense that we've got to be diversified and we have to be thinking about our risks and how we could hedge them.
And just from a conversation that we don't get to have as much as I would like, which is about portfolio construction and like what a baseline looks like now. Because you mentioned alts, that's been a growing sleeve, and it feels like access to those types of investments has really opened up in the last handful of years. What are those conversations like around what, in a vacuum, the ideal portfolio looks like in 2025 versus what it could have looked like in 2015, and how, leaving aside that performance can change those weights, just what that conversation is today around how someone can and maybe should think about where they want to be allocated versus, the world of 60-40, which feels like very anachronistic at this point.
Absolutely. Well, I of course have to give that compliance footnote that every person has a different time horizon, a different risk tolerance. But I think there's a real openness to have as much as or even more than 20% alt exposure. So think of it in terms of like a 50-30-20 kind of allocation, but certainly we know the endowments have a much higher allocation, and I think we tend to see that sort of shift towards more of an institutional mindset among investors. So I wouldn't be surprised to see alternatives grow as a component of one's portfolio. And of course, it's a wide umbrella when we think about alternatives. Because we have private credit, we have private equity, we have hedge funds, and areas like gold, catastrophe bonds, convertible bonds often are categorized as alternatives. So I think it's a very big category under which you can have significant diversification.
Yeah, interesting times. All right, Christina Hooper, we'll leave it there. Thanks so much for the time.
Thank you.
All right, coming up, if you are in the market for a home, you won't want to miss our expert on mortgage rates coming up when we return. Stay with us. All right, the 30-year fixed rate mortgage ticking up once again this week. This marks the second straight week of rising mortgage rates, even as the Fed has begun their rate cutting cycle. Still, rates remain near lows for the year, potentially stabilizing the outlook for housing. And joining us now for more on that, let's welcome in Michael Fratantoni. He's the chief economist for the Mortgage Bankers Association. Mike, thanks so much for stopping by. I wanted to start with what we saw on the rates front. Technically a rise for 2 straight weeks, but in my view, I think a much more stable environment for mortgage rates. And I'm curious how you guys have seen that and what your membership is saying about the environment right now for housing. Has it really improved over the last several months?
Yeah, Myles, thanks for having me. And absolutely, over the last month, we saw mortgage rates reach the lowest level we've seen this year, down into the low sixes. It really stimulated a pretty profound jump in refinance application volume. So those homeowners who had gotten a mortgage over the last couple of years really sensing that opportunity. But then, as you said, over the last couple of weeks, rates drifted up again. That refinance volume has fallen off. But I think for those looking to buy a home right now, there's a lot of positive news. One is, again, mortgage rates are relatively low compared to where we've been the last 3 years. But two, and probably more important, there are a lot of homes out there available to buy, and that's a very different picture than what we've seen the last couple of years.
Yeah, let's maybe decompose that as you outlined it there, and let's talk about, let's start with the home buyer part of the market. And as you guys see it, how much pent-up demand is there really in that market? And to what extent does finally getting, a 5 handle maybe on the 30-year at some point next year, how does that in your mind and your team's work show what the unlock could be in terms of folks that have been waiting on the sidelines as a result of rates, really saying, okay, that's my number, I'm in, and you've got lines out the door at open houses?
Yeah. So you start with the first-time home buyer, right? So there are 50 million people in this country right now between the ages of 30 and 40. So really at peak first-time home buyer age. It's been a challenging environment. I mentioned the move from a really tight inventory environment to one where homes are more available, but affordability is still a challenge, right? Obviously, home prices did increase a lot before now really stabilizing. And we went from record low mortgage rates during the pandemic to rates touching almost 8% at one point. So it's been a challenge for those first-time buyers, and I think that's where a lot of the pent-up demand is. Beyond that, the move-up buyer, the lock-in effect has been talked about a lot, where someone who got one of those record low mortgage rates back in 20 or 21 has just been reluctant to move. But over time, more and more life events happen. People have children, get married, get new jobs. Lots of reasons why they might be ready to sell and move to that next home. So I agree with you. I think there is a lot of pent-up demand in the market, and this latest drop in rates might be enough to spur people to buy. Even though in the fall, you generally see a little bit less activity than the peak time during the spring.
And then that refi piece of the market, how quick have we seen folks be, to go ahead and start the process to refinance with the move lower in rates? It feels like it's been a very sensitive number. I don't know how, if this is anomalous in the broader context of, how this market usually moves. But it felt like the second you started seeing that 30-year under 6.5, people couldn't get to a refi fast enough. Is that kind of what it felt like to you?
That's exactly what we saw in our application data, where exactly at that moment where rates started to drop, really reflecting some of the weaker job market. Again, the expectation that even short-term rates directed by the Fed might move lower. You had a lot of people all of a sudden very aware of the opportunity they had. Again, folks who got an initial mortgage between sort of middle of 2022 and middle of 2025, they had seen rates, up to a percentage point or more higher than what we see in the market today. So really substantial opportunity to lower their monthly payment.
And then thinking about the housing market broadly, I'm curious what, from your seat, it looks like in terms of the bifurcation, both in terms of the home price that we see, how willing buyers are at certain price points. It seems like we see triggers depending on the market. And then, as I got to there, the geographic bifurcation that we've seen where certain markets have been tight, they've been strong, there's really been no weakness, whereas others, it's been, year 3 really of a much softer environment.
Yeah. On the geographic point first, in those markets, particularly in the South and the West, where builders have been much more active putting up new construction homes, we've seen inventory levels rise pretty quickly and really above sort of more balanced levels. So you're even seeing some price declines in some of those markets. Just think of sort of the Sun Belt markets as a catch-all phrase. But if instead you look in the Northeast or the Midwest, where you didn't have as much new construction, prices are still growing and certainly have held up to a much better level. So it depends on where you are, and then also depends on sort of where you are within that price range. So as always, sort of entry-level properties, the market tends to be a little more competitive than if you get into the middle of the range or at the high end of the range in terms of home prices.
Now, I'll leave you on this one. We've seen a little bit of an uptick, nothing notable, but something that you could point at around the use of ARMs. I think it makes some sense in some situations, right? I think it's a safe-ish bet to say rates are probably not 6.5% in 5 years, depending on exactly how you do that. What have you guys seen on that front? Do you have concerns around this, or is this the kind of thing that, a mortgage banker is saying, hey, we can be a lot more creative with your financing options here than just having to say, do 30 or 15?
Yeah, no, great question. So our data showed the ARM share, which had been as low as about 3% a couple of years ago, is now sort of low double digits, somewhere sort of 10 to 12%. ARMs are different today. If you think back before the great financial crisis, ARMs were really short-term instruments where you'd only have your initial rate locked for a year. Now, the typical ARM that a borrower would get, the initial fixed rate is for 5 years, 7 years, 10 years. So that may be longer than they're planning to be in the property. And in order to do that, the lender's offering really a much lower rate at this point, 75 to even 100 basis points lower than a 30-year fixed rate. So our expectation with the Fed dropping short-term rates, long-term rates staying pretty stable compared to where we are today. I think the ARM market's going to grow. But again, these are much safer adjustable rate loans than folks might have thought about from pre-great financial crisis days.
All right, we'll leave it there. Mike Fratantoni with the Mortgage Bankers Association. Appreciate the time.
Thank you.
All right, Capitol Hill is quiet today with no anticipated votes. The government shutdown still in effect. My colleague Julie Hyman takes a look at the practical implications of what that shutdown means.
Essential services will continue through a shutdown, including military, law enforcement, the Postal Service, the Federal Aviation Administration, and the Transportation Security Administration. But those workers will not be receiving paychecks. During past shutdowns, some TSA checkpoints were closed, and travelers faced longer lines when agents didn't show up for shifts. Non-essential services like national parks will close. In the past, some parks were kept open with state help, but with fewer visitor services, leading to reports of damages and trash pileups. The Smithsonian museums also typically close within a few days. As far as benefits, federal Medicare and Medicaid health insurance programs are considered mandatory spending. That means benefits will not be impacted. Social Security will also continue to be distributed, but staffing in some services could be affected and could cause slowdowns. As for SNAP benefits, they'll only be affected if the shutdown lasts for more than 30 days. That's because funding typically only allows the Agricultural Department to send out those benefits for 30 days after a shutdown begins. And when it comes to the market, stocks are typically pretty indifferent to shutdowns, with the S&P 500 rising more often than falling in the past. But it could have an impact on economic data, delaying key releases like the jobs report and CPI report.
All right, time now for What to Watch. The U.S. government shutdown is set to enter its third day on Friday, and while markets have largely shrugged off this event, Friday morning will bring investors their first notable absence of this latest standoff, and that is the monthly jobs report. The Bureau of Labor Statistics earlier this week announcing that it would not be releasing the monthly jobs data during a shutdown. A report that economists had expected to show that some 43,000 new jobs were created last month, while the unemployment rate held steady at 4.3%. And though this report will be released when the government does reopen, this delay may create further uncertainty for the Fed, which is less than a month out from its next policy decision. Now on Friday, Fed Governor Philip Jefferson is set to make remarks on his outlook for the economy, and investors are all but certain the central bank will lower rates by another 25 basis points on October 29th. But with Friday's delayed jobs report and it looking increasingly like next week's inflation data will also be delayed, policymakers and investors alike will move into the first full week of the crucial month of October without some of the most important reads on the U.S. economy. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories. Stay tuned.